Hi, let's talk about investing. If you're new to investing, you may have heard this term called portfolio construction. And essentially what that means is a portfolio is a collection of different assets, together which should provide you some level of diversity. And the reason that's important is because you want to be able to manage your risk while also spreading your bets. Doing so allows you to protect against the downside, meaning to say, if you are too concentrated on a single stock and that stock for whatever reason is not favorable or is just not well positioned in the market at that time, then the value of those holdings could go down very significantly and you could effectively lose money. Whereas if you're diversified and you spread your bets across multiple stocks or assets, this can actually provide you some level of protection. And so that's why, we talk about portfolio and diversification and the importance of that. Now you might say to get the best performance, you should only focus on maybe just a few stocks and be more highly concentrated. And that can hold true, although it's generally more risky if you do that. The companies that tend to have the highest performance are also what we know as being quite volatile, meaning it's true that they'll go up, but sometimes not always, actually never really in a straight line, and there's going to be bumps along the way. So the companies that run up the most also tend to see the biggest sell-offs, all else being equal, because of the fact that they have generated so much excess profit. People look to sell their winners first, usually. That's not always the case, but it is part of the market dynamics. On the other hand, you might have companies in your portfolio that may underperform the overall market over a period of time. And depending on your time horizon, it might be okay to have those companies still in your portfolio, because it could be that they're just not in favor at this particular moment within the market cycle. But if they are good fundamental companies, the expectation is that their stock should go up over time. So if you have a longer term time horizon, really your best bet is to focus on selecting good, high quality companies with excellent growth prospects over time. And the way you evaluate whether a company has good growth prospects over time is you want to find companies that are in what's known as growth sectors, or areas of the economy that are expected to grow faster relative to other areas of the economy. What do we mean by that? Well, here I've generated a sort of a random portfolio just to give you an example of how you can quickly generate a diversified portfolio using our platform. And as you can see, I've got a whole different range of companies and we can see their performance over time, and they're all a bit different, because we have 10 companies in our portfolio, and each of them are in a different sector. These sectors include IT, financials, basic materials, communication services, healthcare, energy, industrials, consumer staples, consumer discretionary, real estate. And we can go into some of those details in a moment. But what I want to show you is that, when we're looking at picking companies, one thing that we want to find are companies that have good, strong fundamentals and are in kind of secular growth areas. A great example here in our case is probably the best performer in our portfolio, or one of the best performers, which in this case would be Broadcom. So Broadcom is one of the biggest semiconductors. These are like computer chip companies. So they're a leader that is definitely a very hot space right now. And as you can see from their price trend, their stock has grown significantly since 2023 when we are tracking this data until now. So for almost about a year and a half or so, they've experienced a tremendous growth. We can also see, if we only want to look at our year-to-date performance, so just what's our performance this year, we can still see that Broadcom is one of our stronger performers. So that's an example of a growth area company. The other thing that we have in our portfolio here are companies that may not be necessarily considered growth areas, but are more stable or defensive. Meaning to say that whether or not we're in a recessionary period or we're in a kind of expansionary period within the economy, these are going to be companies selling products and services that people are going to buy regardless. That's why in this case Mondelez is a consumer, what's known as a consumer staple. Consumer staple is a little bit different than consumer discretionary. The key difference here, as it's defined, is that a staple is something that you're going to almost always purchase. So these are things like groceries and basic goods, milk, cheese, eggs, toothpaste, toilet paper, that sort of stuff. Whereas a consumer discretionary purchase is more discretionary. So when you have the money, when you have the time, and those are when you make those kind of discretionary purchases. They're not your staples, but they're like kind of nice to haves. And in this case, we can see here that Norwegian Cruise Line Holdings is considered a consumer discretionary purchase because going on a trip, having a cruise trip, traveling, that kind of thing is more of a discretionary thing. That tends to be when people have a little bit extra money, more time, and they'll go and make these kind of discretionary purchases because they want to sort of enjoy their time and so forth, and take some time off and purchase something that they might not normally purchase on a monthly basis. Whereas your staples are going to be things that people buy all the time. Now Mondelez, you may or may not have heard of them as a company, but you've probably heard of their brands. It used to be called Kraft. So as we know, like the Kraft, macaronis and cheese, and they also make Oreos, Ritz, Cliff Bars, other things. So, chances are if you go into a grocery store, you're going to probably purchase at least one of their products. And so that's why it's considered more of a defensive company, defensive part of your portfolio. It will have fluctuations in its stock price, but it's less likely to have a huge run up, and at the same time it's less likely to have massive fall off. It will, it's less likely. Not to say it won't happen, but it's just less likely. So your example of your defensive in this particular portfolio is a consumer staples company. Interestingly, though, the airlines are considered part of the industrial sector. So Southwest Airlines here and Norwegian Cruise Lines, these are two different sectors, but to me they're very similar. And so when we talk about diversified portfolio, the other thing you kind of want to aim for is not having too much overlap. Overlapping is essentially, kind of diluting your potential. So if you have only limited funds and you can only afford to buy a certain amount of stocks, you're probably better off not having too much overlap, because you're not getting any extra, let's say, potential return for the risk that you're taking. So in this case, I would probably want to look at my portfolio, and in this particular case, I have Southwest Airlines and Norwegian Cruise Line Holdings, and I'd want to decide which of these two companies I think would have the better performance over the long term, and pick one of them. Now, again, it doesn't necessarily have to be the kind of companies that you personally would purchase from more often, although that can be a factor. But you want to think more long-term, broad, macroeconomic. What is it about these companies and the structural part of the economy that will allow them to either grow or stagnate, and so forth. So here you're really thinking about two completely different but somewhat similar types of companies. Southwest Airlines being an carrier covering mostly the southwest part of the United States and into sort of the looks like South America, Central America, Caribbean area as well. So that's going to be kind of like traveling domestically within the United States and also traveling internationally, but not long-haul flights, not really trans-Pacific, cross-Atlantic type of flights, but mostly regional within North America, Central America, South America, Caribbean area. So here you're really thinking about, what are the prospects of Americans flying around the southwest of the United States, taking domestic flights, maybe going from Texas to Los Angeles, San Francisco to Arizona, that kind of thing. Although I understand Southwest Airlines is adding new routes and potentially going to cover even more of the United States. But it's kind of in their name, Southwest Airlines. So you're kind of taking a focused bet. If you are going to look at an airline carrier, and your choices are, Frontier or Alaska Airlines, or United or Delta. All of these have different coverage areas. In this case, this is Southwest Airlines. So you're thinking about, which of these airlines you want to play for your kind of tourism, traveling kind of part of your portfolio. Now, as we're comparing Southwest and Norwegian, the thing about Norwegian is this is non-air travel. This is cruise lines, and mostly with cruise lines, it's purely discretionary. So whereas a domestic flight you might need to take for work, for example, business travel, or you need to maybe travel across different states frequently, then it makes more sense to fly rather than drive. So that's less of a discretionary purchase. It's something that you may actually kind of need to do for your work or whatever, your other responsibilities. Whereas a cruise line is not a transportation service in that sense. It's not taking you to a destination on demand. It's more like a hotel on the ocean, right? So it's almost purely 100% a tourism travel play versus a transportation kind of thing. So in this case, Norwegian Cruise Lines is focusing primarily on the Mediterranean. Looks like it says here. I'm looking at the details. That's the cool thing about our platform, is that you can really actually zoom in and actually see what these companies are offering and what they provide, and you can also look at their financials as well, which really helps you. So looks like they're based in Miami, Florida. I'm going to assume that they have, yes, it looks like they are offering a lot of travel around the Caribbean, New Zealand, Africa, India. You also have Hawaii, Tahiti, Mediterranean. So these are all going to be your sort of tourism, travel, leisure destinations. So if you think that the global economy, the U.S. Consumer is going to be having more and more trips coming up over the next few years, then you might, for leisure, then you might look at Norwegian Cruise Line. If you're thinking that it's more likely that the consumer will be traveling domestically at a sort of a low-cost or budget carrier, then you might look at Southwest Airlines. So while technically these are not in the same sectors and they do serve different areas of the economy, there is some level of overlap between these two. So that's part of what makes building a truly diversified and optimized and balanced portfolio fun and interesting, because you can ask yourself all these kind of questions and try to make a bet, or in this case, an investment based on how you see the world playing out. Looking back at our portfolio, the collective or the combined performance of this particular portfolio for the year to date so far, so starting from January of this year to where we are today in May, the performance is underperformed the benchmark. The benchmark in this case is the S&P 500 and the NASDAQ. So it's definitely underperformed, and the reason why is, well, you can see the companies that have definitely lagged here. So it looks like Mondelez has been one of the laggards. It looks like PSA has also been a laggard, which is public storage. Yeah, interesting. So we were talking about defensive companies, right? So in a diversified portfolio, you do want to have your growth stocks. These are going to be the sectors that we talked about before, chips and information technology, these kind of growth areas. But you also want to balance that out with some defensive, because as we said, if there's a recession or if there's economic downturn, the growth stocks are the ones tend to get hit the most or be the first to sell off, because people have gained so much that they want to cash those out. Whereas the defensive companies like the staples, and in this case potentially real estate, sometimes don't have as much growth, but they also shouldn't lag the market too much either over the long term. They should be steady growers. Now, the thing about public storage is that within the real estate sector, public storage fulfills a very specific kind of, or they cater to a very specific type of customer. Public storage is obviously, they buy lots and lots of warehouse units and give people kind of self-service storage that they can manage. Then people can put their stuff in, and they pay rental to lease or rent one of those storage units. That's a pretty resilient industry. You have to imagine that whether the economy is doing great or not so great, people are going to need storage. Think about it in the case where the economy has a downturn, and then you've got to start maybe downsizing your home, or maybe move to a different lower cost part of the country. In that case, you might have a bunch of things you want to put in storage. So public storage in that case could benefit from, or at least be a resilient company in the face of an economic downturn. At the same time, when the economy is growing, people might buy more stuff, and they might feel less need to sell their old stuff, and so instead they might put that into storage. So either way, public storage could be a kind of a defensive company, but the reason why it hasn't performed as well year to date could be for a variety of reasons. And so it looks like it's been a decent performer over the last year and a half or so, if we just sort of zoom out. But it's still underperforming the market to a significant degree, and it looks like that has started to really happen as of around the start of this year. At that point, it really started underperforming even more. So it's curious to know why that is. One way to do that, I guess, is you could look at their financials. And so we could go in and look at their financials if we wanted to, but you can kind of get a snapshot of it here. And what you see is that it's a little bit expensive, right? How do we know it's expensive? Well, there's these ratios that you can look at, things like PE ratio or PB ratio, price to book, price to equity. But other ways to look at it is simply just doing a ratio of market cap and net income or revenue. And by various metrics, whether you're looking at revenue to market cap, that's a 10 times ratio. So the market cap is 10 times more than the revenue. If you go based on net income, it looks like it's 20 times. Free cash flow is similar. So it's kind of expensive. It's on the more expensive side, I would say, for a real estate company. So that's something that maybe be reflected in the price. Maybe people are starting to think it might be overpriced and selling it down a little bit. So something to just consider. sometimes these companies just get their valuations just get out ahead of them more than their actual fundamentals or their growth. So it may not be anything to do structurally with the company. It could just be that the expectations had gotten too high in the market, and after time they realized that it's not growing as they had expected, and so they're maybe reevaluating or reassessing kind of their positions, and tends to be that more people are selling. So that's why stock prices go up or down. When prices go up, it means that there are more buyers than sellers usually. And when stock prices go down, it means more people are selling than buying. And so it looks like over the last trend of probably roughly this year or so, more people have been selling their positions in public storage. So that's what's kind of bringing down the overall performance of this particular portfolio, because again, this is a combined performance, so it's the average of all the holdings in this portfolio. What you're looking to do is to at least get parity with the benchmark, which most of the time is S&P 500, and in ideal scenarios, you're trying to actually beat the benchmark, which will be performing better than if you were just to buy an ETF or a fund that tracks the index itself. So that's kind of what most people would recommend. That's probably the best advice for most people, is to just buy the index. Then you get the full basket of the 500 companies, largest companies on the market, and that's typically a very good investment over time. But if you wanted to play stock picker and you wanted to really customize your own portfolio and express your own ideas and your own sort of themes, then this is where I think you can have fun and actually trying out different portfolios and trying these different constructions and seeing how you can actually potentially beat the market and outperform. So while it would be very logical for me to keep a defensive company like Public Storage, the market just hasn't rewarded it that much in recent weeks or months. It's just something to think about. So that's been one of the drags on my portfolio performance, and the other one has been the Southwest Airlines, in fact. So that is another one that has been kind of underperforming. So if we looked at the difference between Norwegian and Southwest, Norwegian has performed, looks like, quite well this year so far, whereas Southwest is clearly not doing as well. Let's just compare the two of them, just so we can look at the difference in their performance. So in this performance chart, what I'm sharing here, or what I'm showing, is the two benchmarks. Let's just make it easier for the S&P 500. My combined portfolio performance and the performance of Norwegian Cruise Lines, which is the light blue bar you see, the trend line. And then you have at the bottom here is LUV, which is Southwest Airlines. And so you can see that they have been, in some cases, quite correlated, meaning the two stocks are going pretty much in a similar direction, because they might have a lot of overlap, or people might be expressing an overall theme of travel and buying baskets that include both of these companies. But you can also see that there was a clear divergence where they were going in different directions, and that started right around end of February. So at the end of February into the beginning of March, Norwegian had another sort of step up in their pricing, and we can see that Southwest had been taken down a bit in that kind of price. So that's a little bit tough, right? So you kind of want to decide whether you want to keep one or the other. Now, the thing about it is that Norwegian also has the biggest on an absolute basis, it's also losing the most as well. So although it's going up the most, it's also dropping down a significant amount as well. So there's a lot of volatility in that particular stock. Anytime you see a stock trend with these kind of large movements up and down, rather than more of a gradual or kind of somewhat linear or exponential curve, that shows you that there's a lot of volatility, and that these might be trading vehicles where in certain months, or depending on the calendar, they might be in favor, and then in other months they might be out of favor. And so you can clearly see that there's probably some seasonality to a company like Norwegian Cruise Lines. It could be due to things like cash flow. It could be due to things like how much they're selling tickets. It could be due to things like weather. And so you're actually seeing larger movements. So that's why it's not very always so obvious or clear to say which is the better investment, because it depends on how much volatility that you want to have in your portfolio. So that's just an interesting thing to note here. Let's bring back some of these other companies to look at it, find out what else has been underperforming the market. So the ones that seem to have underperformed the most have been, it looks like there's this other company called Hologic. Hologic is actually a medical devices company. So healthcare in general is considered a kind of a secular growth industry. You know, that if you look at all the companies in the world, or the stock, all the companies listed on the stock market, the sector that generates the most cash, the most revenue, so basically the biggest of them all, is not information technology. It's not the tech companies. It's actually healthcare. Healthcare is it generates the most revenue, or in other words, consumers spend more on healthcare in aggregate in terms of revenue, spending across pharmaceuticals, hospitals, medical devices, anything to do with healthcare. We spend as a society more on that than on any other sector. So in many ways, it's the biggest sector is healthcare. So when it comes to healthcare, what you're trying to do is to separate which companies have the strong growth potential and which companies are going to be potentially disrupted or will not experience as much growth going forward. Now, it looks like the market has been selling off Hologic, possibly due to performance, but it could also be due to the actual portfolio of products and services that they have specifically. You know, within all of healthcare, which are the areas that are going to grow healthily, not to use the pun, and which companies are not as well positioned for the way that the world is moving, or the way that the health of the consumers is moving. So it could be that the market sees Hologic as not having the right mix of products and services in their portfolio for this particular new kind of consumer health trend that we're on right now. Maybe we're starting to solve or cure some of the diseases that they had previously been treating, or maybe there's new treatments on the market that are going to make Hologic's products less needed potentially. Or it could be just that there's, poorer performance in their fundamentals, and the market sees them as being overpriced. PE ratio of 38 is quite high. That signifies that the market thinks that they are kind of an innovative company, that they produce products and services that maybe are difficult to replicate or to replace with cheaper products. So the market has given them a premium. But if you look at their revenue to free cash flow, or their revenue to net income, their profit, they don't have that great margins. So they generate a lot of revenue, but they're probably spending a lot in other areas, possibly investing it back into the business, research and development. It could be that it just costs a lot to produce their products, and so while they charge maybe a higher price for it, it's because they get very potentially low margin to the bottom line. So you'd want to look into if this is the right company. Again, I'm not making a judgment call on them. I'm sure they offer really great products and solutions for customers and for patients. But in terms of the market, that's one of the laggards in our portfolio here. The other companies in our portfolio include financials, the Bank of New York Mellon Corporation. So this is actually a company that is a bank, kind of you can think of it as a bank to other banks. They're kind of like a custodian bank, I believe, if I'm not wrong. So they hold a lot of money that other banks, on behalf of other banks. It's interesting, it looks like they also, so it serves central banks and sovereigns, financial institutions, asset managers, insurance companies, corporations. So it's kind of like a B2B bank. Not so sure if they actually have a large consumer part of their business where you as a regular retail consumer can get a bank account with the Bank of New York Mellon Corporation. It sounds like they're more of a B2B business to business bank. And that looks like that's actually been a strategic and smart move for them. And looks like the market has been rewarding them quite handsomely. They do have a very strong performance so far, it looks like, the year to date here. So that's been a standout performer in this portfolio. Their ticker symbol here is BK, and it has just beaten the benchmark of the S&P, so it's outperformed the S&P so far this year. And on a one-year basis, it looks like it has also done significantly, exceptionally well, which is not always common to see for financials to be to have such a premium over the index. So that's a good pick for right now. It looks structurally, it looks like that is a safe play, and also their financials are a little bit different than other companies. So you always have to treat banks and insurance companies, their financials, a little bit different because of the nature of their business. But if we are looking at a price to book ratio of 1.13, that is seems reasonable for a bank. Normally it's around 1.0. So that doesn't seem to be too expensive. On a PE basis, it might be, it does have a premium, and definitely from a free cash flow to revenue. But again, we have to treat financials differently than we would other companies that are selling actual products and services, because the financials, the banks, the insurance companies just make money from money, so their financials are a little different. But that's an interesting one. Other strong performers, looks like, has been so far this year at least, has been Disney. In this case, it's one of the best performers of this portfolio so far. Looks like Disney this year's up. At one point, it was up around 35%. A bit of a sell-off the last week or so, but it looks like it's at almost 17% up this year, whereas the benchmark for the year is only around 9 to 10%. So it's almost double the benchmark's performance. So it's definitely one of the reasons why our portfolio is doing better than not as bad as it would have been. So that's the thing, is about spreading your bets, using different sectors, different companies to help manage your risk, But again, of course, by having this kind of approach, you do have the possibility that you might have companies that lag in your portfolio, and that would sort of drag down your overall portfolio performance. But as long as you have a conviction that these companies will do well over time, you should be fine. But the nice thing about our platform is that you can quickly identify the companies that have underperformed, sort of lagged the market, and you can swap them with other companies. It may not be the best choice for you. In some case, you may just want to remove that company from your portfolio. And with those laggards removed, you would then see what the portfolio performance would look like. Now, that's on a year-to-date basis. On a one-year basis, this particular portfolio has almost perfectly mirrored the S&P. So, that gives you a good sense of how the S&P works. You're going to have some winners, some losers, but in general, the winners win much more than the losers do, I guess you could say, to kind of put it in a way. And then because of that outperformance from those standout companies, it actually lifts the entire index. So that's what this portfolio would look like if you were to build a 8 stock equally diversified across 8 different sectors. That's just one way to come up with a portfolio idea. There's actually lots of different ways to come up with portfolios. This is just using kind of a random sort of generator and allowing you to kind of just discover companies very easy at a click of a button. But there's other ways that you can actually build your portfolios as well, and that could be using our chatbot. So here, let's take a look at a portfolio of stocks, of industrial stocks in HVAC and parts manufacturing. HVAC is heating, ventilation, air conditioning, and parts manufacturing are going to be those factories that produce widgets and pipes and motors and fans and belts and all kinds of different things that other companies and machines need. So those tend to be, generally speaking, pretty good businesses to be in, because again, they're sort of defensive in that people are going to need heating and ventilation and air conditioning, right? Like whether you're living in a hot area of the country or a cold area in the country, you want your help with your climate control. And as we can see, just by looking up some of the players in HVAC and parts manufacturing, just that alone has produced a portfolio that has actually outpaced the index, the benchmark. And if you look at it on a 1 year, it's doing very, very well. Now there does seem to be in this grouping a laggard, which has performed not as well as the others. But depending on when you entered into that stock, it looks like the performance of this group is almost mirroring each other. If you kind of zoom in, yes, there was a point in time when there was a big sell-off with looks like JCI, but after that point, the performance is actually quite mirrored. So it all comes down to what your cost basis is, your entry price when you got into the stock. And if you were just looking at this on a 1 year basis, so 1 year from today, 1 year ago, the group of this portfolio has performed very well. Let's look into JCI just to see what about it caused that issue. It looks like there was some kind of sell-off in the August of last year, right around the time when it looks like LII saw a big run up. So sometimes what happens is companies or investors rotate out of one company that falls out of favor for whatever reason and and another company benefits from that because the money has to flow somewhere. So it looks like there was a possible rotation within the industrials where the Lennox International company experienced a huge boost to its stock price due to more buying pressure, more demand, whereas it looks like some people decided to, or some in the market decided to sell out of Johnson Controls. Now, what do these companies all do? Pretty much they are building things like ventilation, heating, air conditioning, building management, refrigeration, this kind of stuff. So if you think about a grocery store, they have to build, they need to keep certain areas or certain products temperature controlled, right? You have your freezers, you have your refrigeration, you also have your areas like the butcher areas and that kind of thing. So temperature control or temperature management is really important for fresh foods, for example. You also have things like furnaces, heat pumps. These are going to be important for businesses and homes located in areas where it gets really cold. So either way, whether you're or if you're in the desert areas, for example, where it gets really hot or humid, you might need more air conditioning. And you also have the hot water and cold water that you use when you take showers and so forth. So these companies are involved in water heaters, air conditioning, ventilations, gas compressions, fluid transfer, pumps, these kinds of things. So very, very technical, interesting, mechanical kind of businesses. A lot of them tend to be in sort of middle America or even like Europe, for example. Johnson Controls is headquartered, looks like, in Ireland. That could be just for tax reasons. I don't quite know exactly. It looks like it's a very old company in Ireland. And then you have this one called Pentair in the United Kingdom, and again, very old company, commercial pool maintenance, pool repair, looks like construction. So anytime there's a new building that's being built, you need to install all this HVAC equipment, right? At the same time, you need to maintain these things over time. You have to replace parts and so forth. The vents get dusty, and eventually the motors fail, or the pumps need replacement, or you need more coolant and this kind of stuff. So these companies are going to be in it for the long term. As far as humans, we need to manage our climate, we need to manage our temperatures, we have to we need heating in the cold, and we need air conditioning in the heat. And that's just part of life on this planet. So these companies have, I would say, strong prospects for the long term. Now, having all of these companies in a portfolio is, again, not that diversified. There's a significant amount of overlap. And as you can see, they kind of trend as an industry group. So if you're really, what you want to do is maybe pick one of these companies, find out which one that you think has the most potential, or maybe the best valuation, growth potential in terms of revenue, or one that's undervalued, or that will continue to outpace the rest of their competitors, and then that might be the one that you want to incorporate into your portfolio. So that's a very concentrated look at comparing a bunch of companies in a very specific sector. In this case, that's the sort of heating, ventilation, and so forth. You could also look up companies that are, right now pretty popular, which are the AI stocks, right? So what are the AI stocks? Those are going to be things like Alphabet and Microsoft and Nvidia, right? These are companies that are monetizing, building chips using AI, or buying the chips and then providing services which use those chips. And this is going to be obviously one of the best performing kind of groups over the last year, maybe taking possibly Intel or IBM out of that for the moment and just looking at Apple, Microsoft, and Nvidia. These are probably your best performers over the past year to date. So as you can see, just these companies alone have on average gained 33% on this year to date, whereas the benchmark is only at 9%. So kind of like pick any one of these that you want, and you would have outperformed the benchmark just with one of these. Now, you could say that they're all too similar, but technically they're in different areas. And in fact, Google or Alphabet is considered communication services. It's not even considered an information technology company. Why? Probably because they do a lot of advertising. It's very content-based with things like YouTube and web search results. So it's considered an information services company. Microsoft and Nvidia is considered an IT company, information technology, because they sell products and services to other companies that buy their technologies. So Microsoft sells their software, obviously, and Nvidia sells their chips, their GPUs, their graphic processing units. But all three of these companies are benefiting from the trend in AI in their own ways. Microsoft has made a significant investment in OpenAI and is incorporating AI across all of its Office suite and probably into Windows as well. Nvidia has been probably the most important company over the past year, just because everyone needs their chips to make all this AI possible, to train these large language models. Turns out those graphics cards that were used to being used for video games, and then in some cases even for things like crypto mining, the architecture of those chips work really well also for AI training, just because of the nature of the way that it can process data. So that was that kind of took the market by surprise. And then Alphabet, obviously people think they helped to create these large language models and have done a lot in artificial intelligence and machine learning research. So the question is really around, can they get consumers to adopt AI, and can they use AI in their business to generate more profit? But these are companies that are definitely secular growth companies and should grow for many years ahead. So again, just like we were looking at those HVAC companies, probably pick the one that you like, or maybe two, and then add that to your portfolio. Same with these AI companies. You might want to pick one or two and then add that to your portfolio. Right? Another sector we could look at real quickly is renewable energy companies. There's a number of them that are public. These are going to be things like solar and wind and hydropower. Even Tesla is considered a renewable energy because of their supercharging network and all the batteries that they produce, and also because Tesla acquired SolarCity, which is a solar panel company. But if we looked at just a collection of companies involved in renewable energy, we would probably see some divergence, some doing really well and some definitely out of favor. So as a whole, this group has definitely been out of favor year to date. It is definitely lagged. We can see how the market has not really, possibly it could be that the year prior to this, these companies' prices got bid up so high that now they're kind of coming back down to earth. Could be that their growth rate is just not that high. I'm also noticing that a lot of them don't have huge market caps. So when the companies are not that big in terms of market cap, their movements can be more volatile. I mean, their price can shoot up really quickly, it can drop down really quickly, because it doesn't take much buying or selling to move those companies' price. But that's not to say that all the companies have underperformed. It looks like First Solar has been kind of a standout here. So if you were looking at a renewable company and that was important to you to have some renewable energy in your portfolio, then in this grouping, your best bet would have been First Solar. And you will have noticed that on a 1-year basis, it has not performed particularly well. But on a year-to-date basis, in the last 2 or 3 months, it has grown significantly. So there may be something underlying about this company that is starting to get people looking at it more. It could have had a great quarterly report and maybe given great guidance, and now investors are looking at this company again. It could be that the price is still under or below its former high, and the market expects that it could reach that point again. So that might be a company you look at. First Solar, based out of Arizona, looks like they provide renewable energy, solar technology to companies all around the world. And it looks like it's been around for 20-something years and has been, in recent months, growing pretty well. So that's just something to consider there. But that's kind of what I just wanted to talk about so far today. It's just give you an overview of the importance of portfolio diversification, how you go about picking stocks, what to look for, and how this platform can make that easy for you. So hope you enjoyed this episode, and I'll see you on the next one.